Hey everyone, and welcome to this week's edition of Financial Intelligence. A disclaimer before we get started. Note that we are not financial advisors. The content in this video is for educational purposes only. For professional advice, you should talk to your financial advisor. Most people are interested in learning how to manage their finances so that they can retire as fast as possible. To retire early, we need to have enough money invested to sustain our lifestyle without working. In order to achieve this goal, we need to pay down our debts and invest what's left. For most people, retirement funds are held in a 401k account, and debts are typically from credit cards and student loans. Ideally, you will be able to save enough money in your 401k and pay off your credit card debts. However, money is scarce, and we all know that this is not always possible. Therefore, a common question that arises is, should I pay down my credit card debt or put that money towards retirement? The answer is not as obvious as you might think. In this video, we are going to discuss how to answer this question in 3 easy steps so that you can make the best decision for the short and long term. To kick us off, we'll set the stage by brushing up on 401k and credit card basics. So, what's a 401k? In short, a 401k is a retirement savings and investing plan that most employers offer. The way that it works is simple. You set up automatic payments that are withdrawn from your paycheck and invested in funds of your choosing. There are 2 great advantages of 401k plans. Number 1 is that your 401k payments are made from pre-tax dollars, meaning that you get an automatic tax break on money that you contribute. Number 2 is that most employers will match your contributions up to a certain amount. This means that you can literally get extra free money for your retirement if you choose to use a 401k. Every 401k plan is a bit different, so you'll have to check your employer's plan for the details on exactly how yours works. But let's consider this common scenario as an example to make it clear. Say your annual salary is $50,000 and your employer matches 50% of what you put into your 401k up to 6% of your salary. In other words, your employer matches half of whatever you contribute, but no more than 3% of your total salary. So to get the maximum amount of match, you will need to contribute 6% of your $50,000 salary, which is $3,000. Your employer will match half of your contribution, which is $1,500, or 3% of your overall salary. If you so choose, you can contribute more to your 401k to, say, 10%, but the employer contributions will not go higher because that is the maximum amount set in this example. The bottom line is that if you are making $50,000 a year and your employer matches 50% of your contributions up to 6%, you will get an extra $1,500 if you commit 6% of your salary to your 401k account. So, what about credit cards? If you have unpaid balance on your credit card, you will be charged interest every month. This is because credit card balance is like borrowed money. These interest charges are usually measured in terms of an annual percentage rate or APR. Simply put, APR is the total cost of borrowing money, and it is usually charged monthly as a percentage of your credit card debt. Let's say that your annual percentage rate is about 15.5%. That means that you're going to be charged about 15.5% divided by 12, or around 1.25% each month. So, if for example you have $3,000 of credit card debt, you would be charged in the first month $37. Your total due the following month would be $3,037, and the month after that you'll be charged another round of interest against the new balance, which is $3,037, getting you to a little over $3,075. If you fast forward to the end of the year, you'd end up owing around $500 in interest instead of the $465 that you may have expected. You can see how this can quickly get out of hand. This is all due to monthly compounding forces. But let's not worry about the difference between yearly and monthly compounding rates. All we need to remember is that at the end of the year, you would owe around $3,500, of which $500 is from interest and the $3,000 is from the original balance, also known as the principal. Now that we have learned about the basics of 401k and credit card payments, let's see which one makes the most sense if we have scarce funds and our goal is to make the best financial decision. Now we can go back to our original question. Should we pay off credit card debt first, or should we contribute to our 401k? To answer this, let's take another look at the facts in this example. Your annual salary is $50,000. and your employer matches 50% of what you put into your 401k, up to 6% of your salary, and you have $3,000 of credit card debt. Now, assuming that you have $3,000 to work with, you have a couple of options. 1. Contribute the full $3,000 to your 401k. 2. Save a bit and pay a bit. Or 3. Pay off your debt entirely. Now let's see what happens if we go with option number 1. You will contribute the $3,000 to your 401k, and your employer will match and put in an additional $1,500 to your account. However, you are going to be charged $500 of interest on your credit card. Overall, at the end of the year, you will come out with a positive $1,000. Now say you decide to go with putting half of your money into your 401k and paying half of your credit card debt down. In this case, you will pay only $250 in interest charges and receive $750 from your employer match because you did not take advantage of the full match. You will end up with an extra $500, which isn't as good as option number 1, but still positive. Now let's say you go with option number 3 and pay off your credit card, which will save you $500 in interest, but you will miss out on the $1,500 of free 401k match because you did not put any money into your 401k. In total, you will lose $1,000 that you could have otherwise received. So if you have more than $3,000 to work with, then you should contribute the first $3,000 to your 401k account and then use the rest to pay off your credit card debt. Make or lose $1,000, the choice is yours. If you like this video, please click on the thumbs up icon below and don't forget to subscribe to get more tips and tricks from financial intelligence.